Okay, I think we should just jump into the first article here. I wanted to start with these reports from CBRE and Yardi Matrix. They're kind of now we had an update, an overview of all the markets from CBRE last week, and we covered kind of their changing economic projections. And this week, CBRE has a mid-year pulse check on the U.S. multifamily market, kind of drilling in a little bit more closely with their assessment of multifamily. Interesting that they note here the amount of investor attention in the multifamily market. They say right there is like kind of their second bullet point. For the first time since CBRE began polling investors, respondents to CBRE's Global Investor Intention Survey in late 2022 said that they would target multifamily properties more than any other property type this year. I think that multifamily has ranked at or near the top of a lot of other lists of kind of investor preferences. So I'm not really that surprised that it would rank so highly here. I am interested in kind of like the level of like how much they're leading other assets. And it's not like a dramatic increase, but it does reflect, I think, a greater attention on multifamily, probably as seen maybe as like a little more stable than other sectors. I think office has its own problems. Industrial seems to be still like pretty healthy, but it's not like it was, even like last year. And retail is, it's just a little bit more ups and downs. It's strange to think after, such highs and lows, and really multifamily has had a bumpy ride itself, just relatively less bumpy maybe. And I think investors are probably kind of cluing into that. I don't know if you've seen any increased investor attention. I asked you this beforehand. My big question for you is kind of a larger question. Are you seeing more competition amongst other buyers for a given multifamily property than you are now? Are people kind of falling away? Are investors crowding in? Like how much attention, how scared or attractive is scary or attractive is the multifamily market for investors right now?
Well, there's two different parts of that. I think we have, on deals that we've looked at and deals that we've come close to penciling on, we have had I don't want to say a ton of competition, but there hasn't been a deal that I can think of where we're one of three people or one of two people total during the whole process. I think what's going on is you have a lot of people that are on the sidelines that want to transact, that want to buy. Mm-hmm. Nowhere near as many people that are interested in selling. A lot of the sellers are people that are in a tough spot because of the type of debt that they put on their property, or they missed the mark on a refinance, or just, really, the only times you hear about someone selling because it was a part of the business plan seems to be as if it was a development project, or new development, I should say, and they're in a lease up. So I think in that sense, there's still a lot of people that are waiting to get active, and they're looking at every deal they can. And I think that competition is different than what we saw in 2021. A little bit of 2022, but I would say more so 2021, later half of 2020, where you could see some people missing deals because it was a matter of, it's not that there's anything wrong with the deal or anything wrong with the fundamentals, it's the fact that would be their fourth closing in a year and they just couldn't swing it. Or they had other issues going on, or we didn't look too hard at that deal because we were looking at something else. This year, because it seems like the new supply coming out for sale has been a lot less than what it's been in the past. I think pretty much every deal that comes out, you're going to get, I would say, keeping this small and local in Indiana, I would say any deal that is coming out, it's going to get looked at by at least everyone that's an owner operator in Indiana. And then you're going to see people that are around the Midwest that have been looking at it. But also, I would say when we talk about investor sentiment in multifamily and industrial, I think what props up both those things is there isn't really any fundamental changes to multifamily and industrial. I don't know as much about industrials as I would say multifamily, but I don't see anyone necessarily calling out renting an apartment, or since COVID happened, I don't think of anyone coming out and calling into question why you would rent an apartment or anything like that. The way with retail, seems like ever since the 2010s, or really since Amazon
Yeah.
broke onto the scene, it's just, well, how many more years are these malls going to exist before everything's online?
Yeah.
How is retail going to change? I mean, there's always been a lot of that.
There's a larger question mark around retail, I think for good reason, office. I think retail in some ways is like, well, it's stuck around for so long, it seems almost more persistent maybe than office.
Well, and going to the office situation.
But yeah, even then, I think office is not as bad as maybe some people might think.
But also, I mean, when it comes to office, though, you're not dealing with rents have fallen because there's new supply in office or anything like that you would say can kind of affect different markets within multifamily. What seems to be the main issue in the office space is just that remote work has become a thing.
Yeah.
And it's not risk. I mean, yes, there's obviously issues that the owners and operators are facing, but it's a lot of companies that are saying we just can't attract talent wanting or forcing them to come in 5 days a week. There's plenty of stories I heard across the country, and I remember reading of someone in Chicago where the guy really tricked out the office space to have a mini basketball court, just a bunch of different amenities, and he's like, people might come in, but it's 3 days a week.
Yeah.
So I think multifamily just isn't really facing anything like that.
Yeah.
So I don't.
No,
I think
surprise
to me.
Yeah, I think that rings true. It puts a lot of the kind of rent slowdown in perspective, given the kind of the larger pallor that's over all these other sectors, and it's big question marks. Even in industrial, how much can you keep up? The producing more goods. Are we really transitioning into a more service-based economy? So there's larger things and things I don't understand.
Well, I mean, industrial, from what I've heard, is it's not so much that the fundamentals are bad. I've heard more so that a lot of people are looking just for shorter term leases and everything. But again, and then I think that's also another thing that doesn't quite get factored into here is that with the multifamily market, there is some certainty in the sense that this person at the very least is going to be here for 12 months. Obviously, for some shorter leases, you can do some longer leases, but there's kind of a refresh period. There's stuff you can do immediately on the property that can kind of get things churning, where with industrial, retail, anything like that, you do run into the risk of, well, I've signed a 10-year lease with this company, and if they're not, they don't have a great credit rating, or it's not a corporate guarantee, there's a lot more risk there. But yeah, I don't, to me, that was nothing surprising in terms of just kind of multifamily and industrial basics compared to the other group.
So there's a large amount of people interested in multifamily. Specifically, they note that 50% of multifamily investors view high risk, e.g. opportunistic, distressed in debt, as the most attractive investment strategy in 2023. This was more than both office, which had 40%, and industrial, which had 45% investor groups, which I think, that actually makes a little bit of sense of the relative position, because if multifamily is a little more stable, maybe they have more appetite within a more stable sector for a riskier strategy. But I keep thinking about, I've heard about dry powder. I know these people are waiting for, this perfect opportunity. I keep thinking about the situation where everyone is looking for this diamond in the rough, this perfect deal where the owner is running away from an expensive loan and the property is distressed but still has great cash flow. And it's like, you're at a certain point, it's like you're kind of putting your fishing line out on the dock and you're hoping a prize marlin swims by. It's probably not going to happen. I don't think we're going to see these golden opportunities popping up right or left, but I do think that upcoming loan maturities are going to put a downward pressure on cap rates in Q4 of this year and into 2024. But I was also thinking, and this is kind of my larger point, what if upcoming loan and it's kind of the like skeptical or pessimistic view, really, is what if upcoming loan maturities, whatever effect that they have with higher interest rates or whatever to kind of push cap rates up and make deals more palatable for buyers, what if that doesn't really happen because people are so competitive? What if, just like at the beginning of the pandemic, people are waiting for amazing deals that just don't emerge, and the real discount is that prices are just slightly stable instead of measurably lower? To the extent that to extend kind of what I was trying to say with my fishing analogy, minus the fishing, is there are these people out there looking for this perfect deal. That's only a portion of investors, though. There's a whole range of investors, some with a return threshold that's lower than the people out there looking for a perfect deal. And there's a whole, this these buyers might not be knocking it out of the park, but if they've got a plan, they'll buy. And I think that these investors are out there. And instead of like huge opportunities, the opportunities that may happen are ones where, property values may go down enough. It may just be normal, maybe a single or a double or whatever, to use the baseball analogy. It just may not be excited enough to get some people off the sidelines. Now, what I think this would have, the effect that this would have on the market, if there's so many people competing for deals, then the prices aren't going to go down to make it this perfect. I'm imagining this deal that people are looking for, where property values go down enough for them to find a deal. This is the environment, but they also start to go back up again, so you make money when you sold it. It's like you're kind of betting against two things that are at odds with each other, and that's the skepticism I have towards the emergence of this perfect, where it's going to be a case where not everyone's going to be happy. Not everyone's going to be able to find a good deal, and not every seller is going to be happy parting with their property. Now, I still think there's going to be risk associated with it, and there are too many investors who have multifamily as their priority, such that, if things are too competitive, even when deal activity is down, I think if the math works out for a given property, then they'll come out of the woodwork. I don't think it's, I like before I said, yes, plenty of these people are waiting for the knight in shining armor to come along, but I think that's not necessarily going to be the case. It'll be, once the math works out to be like an above average deal, people will come in there and it'll get competitive again. That's like my realistic take. I think there's room. It's still like the onus is on sellers to make this math work, because it hasn't in the way that it has before, pre-pandemic even. But once the numbers are there, you're going to see a ton of competition. So I don't know where the opportunity is for someone like you to find that before everyone else does.
Real quick, I am surprised when they say 50% of multifamily investors view the high risk, opportunistic, distressed debt as the most attractive investment strategy. I'm surprised by that, because I'm thinking of it in the sense where it's deals that have significant value add component to it, or operations are in just such a tailspin that they need someone else to come in and fix things. I'm surprised that that amount view that as the most attractive investment strategy, just because what we've seen and heard is it still seems like there's a lot of investors out there that are placing a premium on cash flow right now.
Yeah.
Not necessarily changing their thresholds on IRRs or moving the needle there, but cash flows at a premium. I don't know if it's going to still be the same in 2024 and moving forward, but general rule of thumb is you want something that's going to be at, if not better than where the treasuries are at in terms of a cash on cash. Mm-hmm. And those deals, the opportunistic distressed, assuming you get things right on the value add, mm-hmm. assuming you get things right turning around operations, or both if the deal requires, the cash flow is going to be there at some point, but very rarely is it there the first year or two.
Yeah.
Unless you're putting, I don't know what it would look like, I guess, with floating rate debt or anything like that. But a lot of the deals that we've looked at and underwritten that kind of have that kind of component, the cash flow isn't the best it could be year one or two.
Yeah.
So that was surprising to me. But that also goes kind of the point that I started off the show with, in that I do think you're onto something about kind of where the competition is going to come and where it settles things cap rate wise. I think looking at pricing of deals that have come to market right now, I think sellers and or brokers have, I know come to grips probably isn't the most favorable term, but the attitude going back to like NMHC, for example, in January, was that, we really had no appetite to do negative leverage deals mm-hmm. in 2022. And we still don't now.
Yeah.
And unless there's any meaningful movement in the treasuries and kind of where interest rates are, mm-hmm. If your interest rate on your debt is still at 6, those cap rates are going to have to be a lot closer for that to make a lot of people interested in the deals. So you're going to see pricing move just based on that fact alone. However, because you've had so many buyers on the sidelines, I think there's going to be more deals that are pushed to market, because a lot of people have come to grips with this. Either A, it was their business plan and they're happy to do it. And they're happy to go along and sell. But also, I think you're going to have a lot of people that their loan is going to be maturing, or they're hearing and seeing what's going on with other people who are in the loan maturity situation, realizing that that's not too far down the horizon for them, and they're getting rid of it. To kind of steal from your path of analogies, I definitely feel like this market has been from the seller's point of view, has been an episode of Pawn Stars, in the sense that someone comes in with, I don't know, some sort of 60s lunch pail or whatever, thinking it's worth $500. And Rick's, called in his expert, usually Big Buddy Mark, and finds out that it's actually worth $100, and now Rick Harrison wants 50 for it. I think there's a lot of sellers that wanted whatever price it was to get returns, and have now realized, no, when someone told me off market that my deal that I wanted 80 million for, I'm going to get 60 million for. After 6 or 7 months of people coming back and saying, well, we'd like to transact at 60, they're now realizing 60 is where I'm at.
And once that happens, and again, a lot depends on that. But I think what's going to motivate, loan maturities is one of them, but an environment where there is no out, and looking ahead and seeing things like, and we'll talk about the Fed in just a second here, but seeing how the Fed could keep interest rates high through 2024. There's going to be extensions. There's going to be deals that multifamily lenders work out. But there is also going to be a lot of loans that are coming due in the next year, and that's a high pressure year with high interest rates that are going to make the math work better if they cut and run.